This episode of Industry Focus is brought to you by Rocket Mortgage by Quicken Loans. Rocket Mortgage brings the mortgage process into the 21st century with a fast, easy, and completely online process. Check out Rocket Mortgage today at quickenloans.com/fool. Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today is Tuesday, May 17th, so we're talking about consumer goods. I'm joined by Motley Fool analyst Vincent Shen, who's going to take us to school on that most exciting of topics, retail inventory management. How's it going, Vince?
I'm doing well, Sean. I personally think it's quite exciting, actually.
Oh, man, I didn't even need coffee to do this. I'm so excited.
But realistically, though, and on a more serious note, this is a really important part of the business for a lot of the retailers. And, I'm kind of going to take you through the gamut of some of the different sectors that we think of, how they manage it, and then kind of take you to the gold standard with a company that has truly outdone many of its competitors. So
would you say that inventory management might be, other than advertising, the most important thing that a retailer can do?
Well, I think it's, for some of the companies that we'll talk about, it is a huge differentiator for them and something that has allowed them to, win really strong margins, to gain incredible scale. Like think of a Walmart, for example, who we'll touch on briefly. But before I wanted to get into any of that stuff, Sean, don't you have something to mention for today's show?
Okay. So I'm actually going to be stepping back from the consumer goods and the tech shows to focus more exclusively on the energy show. And so, Vince, you'll be having lots of cool guest stars and everything. And people got a taste of what I'm going to be doing at the energy show last week when I had Daniel Sparks on, not only a Tesla shareholder, but a Tesla owner. And we talked about their driverless mode and just the future of Tesla and possible share issuances. So it's exciting. We're just continuing to improve industry focus. And one of the ways we're doing that is diversifying our contributors. And I think it's a good move.
Sean, I just got to say that after over a year of doing IF with you, I'm going to miss you.
I bet. I know. This was what I was most sad about. I was like, I won't get to hang out with Vince and Dylan, and I'll just have to go to lunch with you guys more or something.
And I know you like talking about your energy companies, your industrials companies, but come on, you know that the fun stuff is in tech and in consumer.
Oh, I know, like inventory management.
All right, so
can you, for the listener that's rolling their eyes right now, not only because of our bad jokes, but because of the fact that we're about to talk about inventory management of retailers, can you kind of draw them in a little bit, explain what it is, maybe jazz it up a little?
Yeah, absolutely. So just, broad context, this is the idea that, there's a lot involved in when you walk down, the aisle at a grocery store, a clothing store, or even like a big box store like a Target or a Walmart. There's a lot involved in keeping those shelves stocked with the products that you want. There's SKUs, which are essentially the numbers that they assign to identify these products. And when you have, let's say, 1,000 store locations, and each of those store locations at a big box store, for example, has potentially tens of thousands of SKUs. This becomes a huge operational challenge. And when you are looking at a company and generally trying to identify how well it is managing its inventory, we like to generally use, on the investing side, two metrics. So the first one of those is inventory turnover. So that basically tells us how many times a company will sell through the inventory it has in a given period. And this number is calculated. You take their cost of goods sold for whatever time period you want to use. Traditionally, it's like on a trailing 12 months basis. And you divide that by its average inventory balance during the period. So you could take Q4 end inventory for 2014 and then the ending balance in 2015, average those two numbers. And then you'll get a time, like essentially 5 or 10 or 15 times, basically how many times they turn through their inventory in that year period if you're going by trailing 12 months. So then related to this number, you can also calculate their days of inventory outstanding. So this number basically tells you how much inventory they have on hand measured by how many days it would take them to sell through the balance they currently hold. I really like this number because it really makes it puts into perspective how quickly and how quickly a company can sell through its inventory and how much they have and it's all within the metric is days or weeks, right?
Yeah.
So
That's kind of the name of the game in retail, because you just assuming that items are being sold for a profit. The more quickly you can sell things, the more you can use that money to buy more inventory, and the it keeps on spinning.
Yeah, I'm really glad you touched on that, because the ultimate idea is that this company is pouring resources, pouring money into whatever goods it's producing or that it's selling or that it's acquiring from suppliers, right? So the faster that it can convert that inventory into revenue and cash, it's very beneficial to them. So being able to optimize and make these its management of its inventory as efficient as possible is really important to the margins and the profitability of any company. And so for that days of inventory outstanding number, it's a lower number is generally preferred. So the idea that you can sell through it very quickly, but at the same time, if it's too low, you run into the issue of potentially leaving money on the table. If, for example, you don't forecast demand,
You're pricing things to sell,
and at the same time, you basically don't foresee outsized demand, you can't meet that, and you leave money on the table. And another thing to keep in mind with these two metrics is that, on their own, they don't tell you quite as much as when you're comparing them to their peers or their overall industry or sector. That's where you really kind of see through that comparison how well they're doing. So moving on to our first example, I wanted to talk about Urban Outfitters. So recently, I did a lot of research for Urban Outfitters for the Supernova Explorer 1 mission, and
one of the Motley Fool's awesome newsletter services.
Exactly. So I wanted to kind of just look at it for the apparel sector, and we'll kind of get more broad into the bigger department stores like Nordstrom's as well. But Urban Outfitters operates 3 primary chains. They have their namesake, Urban Outfitters, Anthropologie, Free People. They also have some ancillary brands.
And those two satellite brands, I guess, are they're the ones that are growing gangbusters right now, as I recall.
Yeah, for some years they were the ones that were providing most of the growth. Things overall for the company have slowed down. They're kind of in a recovery turnaround phase, but a big focus for the company, you'll hear multiple times in their different management calls, earnings calls, presentations that they do. They talk a lot about their weeks of inventory and managing that number. So I pulled out a lot of my calculations from S&P Capital IQ, but Urban has an inventory turnover for fiscal year 2016 of 6.5 times, and then its days of inventory is at about 56.2. If you compare that to competitors, think Abercrombie & Fitch, American Eagle, The Gap, Express, they seem to be a little on. Urban Outfitters seems to be running a little bit more efficiently. The average for some of those peers is about 4.9 times or 80 days. So basically, it's taking them longer, and they're going through their inventory fewer times in a year. So as I mentioned, with the company Urban Outfitters specifically, kind of going through this turnaround phase. By managing inventory better, basically for them, it reduces the need for them to employ markdowns to sell their goods, and obviously that has a very direct impact on their margins and on their profitability. And the company is basically kind of being trying to do or management its inventory a little better by making some strides in a supply chain by, for example, going through to a single SKU system across all of its channels. Basically, all of its products now, whether you see them in store or online, they're all identified by that same SKU number. And this is basically fostering the idea of the omni-channel strategy that you hear so many retailers employing now. The idea that you want to give a shopper or a customer the ability to buy whatever it is that you're selling whenever and however they want. So whether they're in your store, whether they're at home on their computer, or they're in your store like on the app, which is something that's becoming very common, where a shopper will go into Urban Outfitters and they'll interact quite a bit due to like these beacons that the stores employ. They'll ping your phone if you're a participant and you have the Urban Outfitters shopping app, and gives you special offers. A lot of people end up shopping online while in store. So it's really like blending all these different channels.
I'm really curious, since we're talking about inventory management, I'm very, very curious what inventory days and just how much stores are going to have an inventory in 2 decades. Like, how many things is Urban Outfitters and Macy's and JCPenney and Walmart, how many things are going to have on the shelves? Because You hear all these retailers talking about their omni-channel strategy, and what it's going to entail is having a huge, I hate to bring them up again because you talk about them every time we talk about retail, but Amazon, you're going to have a huge Amazon-like distribution facility. That'll filter out to the stores, but they're not going to have every size and every color of shirts and stuff. I mean, they're just not. It's not worth it.
Well, also another example, more specific to the apparel sector, you look at a company like Zara, which is known as this like fast fashion, very successful. And the thing, something that they stress is that they keep inventory levels pretty slim, and when they ship out a new collection, for example, to stores, they do so on a very limited basis. And this not only allows them to manage inventory very well, but also adds some exclusivity to the new products that come out. So there's a bit more, the elevated demand from shoppers when they think, oh, I might not be able to get this next week if the store's going to be sold out, and that's all they're going to have. And so moving on, still within apparel, but also to some of the bigger stores, I wanted to talk about like Kohl's, JCPenney, TJX companies, Macy's, Nordstrom. So larger chains actually tended to have lower turnover and more inventory in hand. They average about 3.9 times in 104 days. And
so these things are sitting on the shelves for 3 months. I mean, yeah.
So it's just interesting. So basically, it would take them about 104 days to sell through everything that they have. So it's very interesting that the bigger stores are actually, the numbers are a little less efficient, you could call it, but not that surprising. So moving on to another sector, and this is kind of on the opposite end of the spectrum where the apparel retailers are a little slower. Naturally, as you would expect, the fastest turnover is probably going to come from companies that sell perishable goods.
Right.
So let's walk down the grocery aisle, for example. Among major chains like Whole Foods Market, Kroger, Super Value, Sprouts Farmers Market. So average for these peers is about 16 times and 27 days of inventory. So the organic food specialists, Whole Foods and Sprouts, tend to outperform the broad industry. But if you look more broadly at the bigger box stores, like Walmart obviously has pushed significantly into the grocery business. You get a lesson really in how effectively they manage it. They do everything to minimize or to as efficiently run their operations as possible. Even when they get to their distribution centers that you mentioned, like goods get moved from one truck directly onto another truck to go to the stores. It never gets stored in warehouses, or it does as minimally as possible.
I remember I saw this like report or show about Walmart, and they literally use supercomputers to manage their inventory and everything. And it was amazing to me because these things are like, it should be like, I don't know, solving complex problems or something, and they're doing inventory. So yeah.
Well, it is complex, and that's another reason why Walmart has been so successful over the decades. Its numbers are a little stronger than like a Target or a Best Buy, for example.
Yeah, cool. Well, this episode of Industry Focus is brought to you by Rocket Mortgage by Quicken Loans. If you've ever bought a home, then you already know how frustrating and time-consuming getting a mortgage can be. Rocket Mortgage brings the mortgage approval process into the 21st century by taking all the complicated, time-consuming parts of applying for a mortgage out of the equation. With Rocket Mortgage, you can easily share your bank statements, pay stubs at the touch of a button, helping you to get approved in minutes for a custom mortgage solution that's been tailored to your own financial situation. And you can do it all from your phone or tablet. So if you're looking to refinance your mortgage or buy a home, check out Rocket Mortgage today at quickenloans.com/fool. Equal housing lender, licensed in all 50 states, NMLSconsumeraccess.org, number 3030. So Vince, you're talking about the company that epitomizes great inventory management at the beginning of the show. I'm going to go out on a limb and say it's Amazon.
Okay, so this company, and I'd say this generally is probably a company you would discuss on the tech show with Dylan.
It's not Amazon? What are you talking about?
But this is one where I think their retail stores have become famous worldwide. They're almost like a tourist destination unto themselves. I think there was a fun fact on the board here in Full HQ that said that more pictures are taken of the Apple store in Manhattan, I believe the one in Midtown, than are of the Empire State Building?
Yeah, it was the Statue of Liberty.
Statue of Liberty.
I maintain that that's because the Statue of Liberty is harder to get to. But Okay, so it's Apple.
Yes, it is. So here's the company that has the highest sales per square foot in retail. I think it's almost $5,000.
It's second only to, do you know?
Oh, it's first. Who do you think
Per
it's
square
second to?
foot, it's second only to Tiffany's.
Now Tiffany's is number 2 actually.
You're kidding
it's
me.
Better
They
than
beat it
Tiffany's,
out?
yes.
Oh my gosh. All right.
So,
sorry, Tiffany's.
in case you're not aware, just for some really quick background, is Tim Cook, when he took over, before he took over as CEO, he had a long tenure in operations for the company, and he is known for making major improvements when he joined in 1998 that really changed the ability for Apple to not only manage the huge demand that it would have for some of its iPhones and other products, but to do so very, very profitably. So, for example, he scrapped all of their in-house warehouses, all of their in-house manufacturing facilities, and went to the contract manufacturers that have become so famous, like Foxconn, for example. And something that allows them to do is, if you order a phone, it'll likely be shipped to you directly from the manufacturing facilities abroad, and Apple never even has to
do anything,
take possession of them at any time, and that's just very efficient for them. So, it's a really funny quote is that Tim Cook, he's basically several times he's used dairy products as an analogy for inventory. The idea being that kind of like the milk in your fridge, the longer it sits, the more likely it is to go bad. And he's even gone so far as to describe inventory as fundamentally evil. So it's probably a bit of a stretch, but he believed that inventory in hand would shed about 1% to 2% of its value each week in normal conditions, maybe even more so during a challenging retail environment. So it's really important to be able to turn this very quickly. So, with all that in mind, the numbers here are really impressive. So instead of having billions of dollars of parts, components, completed products sitting around in warehouses for them, they don't have to deal with that nearly as much with the contract manufacturers. So trailing 12 months inventory turnover for the most recently reported fiscal 2016, as of the most recently reported fiscal 2016 second quarter, 58.6 times. So blowing out even a company that sells perishables like a supermarket.
Right.
And then their average inventory balance during the period was only about $2.3 billion. So days of inventory, they can sell through it in about 6 days.
I just realized that when I bought my iPhone last spring, it was probably like a week old at that point.
So and I think the scale here is what really is just so incredible and hard to imagine is billions and billions of dollars of product, and they're able to maintain this really just well-oiled machine. So there you have it.
Their revenues were $50 billion. Yeah.
So
yeah,
with those numbers, Tim Cook taking over, he might not. A lot of people will complain or argue that he's not quite the visionary in terms of design that Steve Jobs was, but he was also a huge contributor in his time there, both in operations and as CEO, in developing this model that. And the systems in place that allow Apple to be so profitable, to cut out the costs wherever he can, and to have these crazy numbers. Again, that's 6 days they can turn through their entire inventory.
And this
balance.
is on revenues for the fiscal year ending September 26th of last year of $233 billion. Mm-hmm. I mean, that is just... I can't even conceive of just doing things that quickly.
So beyond some of the other sectors we even talked about, that's one I really wanted to touch on just because it is like this gold standard, I think, within retail.
That's awesome. Well, thanks for your thoughts, Vince.
Thank you, Sean.
Thanks again for being a great partner for the last year.
Yeah, I'm going to miss you.
You bet. Well, that is it for us, folks. If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. And as always, people in this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear on this program. For Vince and Jen, I am Sean O'Reilly. Thanks for listening, and Fool on.